We're going to rock and roll. I know that. I'm well aware. It's been a great day. We've had a lot of good information. It's possible that we're at the point where your ability to focus is only on your hip pockets. So we will move through this pretty quickly. There's a little summary in your packets, not a lot of text, a couple of tables with lots of numbers if you're inclined to look at that for a little more detail. But let's run through a few things right quick on these cattle markets. Whoops. Okay, I went about 3 slides in. Okay, just very quickly, red line is this year. Prices are about 8 to 9% above where we were this time last year. Feeder cattle markets, about the same, 8 to 10% above last year at this time. This market in particular has followed a pretty seasonal pattern, and we'll talk a little bit more about some pressures that are in the market right now. Fed cattle prices are significantly above where we were this time last year. It's been a long, slow grind this year. This has been a very frustrating market for a lot of people. We thought we'd be even higher than this at this point in time, and we still expect to get there before the end of the year. So we're still waiting on some things to straighten up as far as kind of getting caught up on some cattle. Bottom line is last year's pandemic disruptions put a lot of placements at the end in the second half of last year that we had to deal with through the first half, 3/4 of this year. And so we had a placement-induced backlog of cattle. And we've been looking to turn the corner here for 6 weeks already. We haven't quite got there yet, but every day we're closer than we were before. So we'll see when that takes place. Cull cow prices, both last year and this year, actually have done quite well. This particular, we've stayed pretty strong on these cull cow markets. Part of that, of course, is driven by the fact that we do have a pretty strong ground beef market. Fast food restaurants, among all restaurants, have probably recovered quicker last year and have continued pretty strong even through the continuing pandemic problems. Okay, where are we at longer term? Beef cow herd, on the right-hand side, you can see that we've been declining. The cow herd peaked in 2019. Calf crop actually peaked in 2018, coming into that January 1, 2019 number. We've been declining a little bit, not really rapidly. Last full-blown cattle cycle we had was in the early 1990s. We peaked, and typically we fall pretty hard after those. And so we haven't really been falling that hard, and we haven't had strong liquidation things. We've just been kind of drifting lower. This may change that a little bit. You've seen this map earlier today. The drought clearly is adding some additional herd liquidation to whatever we were going to do. We were going to be a little smaller anyway. And the question now is how much additional does this add? The short answer is I really don't know for sure. We can look at beef cow slaughter. It's up about 12.5% over last year. Of course, comparisons to last year are still suspect in a lot of cases because of the disruptions last year. Last year was technically what I call a goofy year. Okay, I went to college to learn that. If you compare it to 2019, we're up about 9% on beef cow slaughter. That's clearly elevated. But some of that was happening through the summer over the last 4 or 5 months was early culling, which is what we would tell producers to do. It's dry, what do? Wean early, cull early, right? So we're really going to have to wait for another 2 or 3 months. It'll be the end of the year before we know how much of that additional slaughter we've seen up to this point was early culling versus how much was net additional liquidation. There's no doubt that there is some additional liquidation, but in the last 3 weeks of weekly data, the year-over-year increases in cull cow slaughter are not nearly as pronounced as they were for about 8 or 10 weeks prior to that. So we are going to see those lines converge a little bit here in the last part of the year. Okay, so, again, lots of drought problems in parts of the country. We haven't seen it affect our cull cow prices. It is affecting hay prices, even in Oklahoma. We haven't had massive drought problems, sporadic. Certainly September was really dry. I think in general, we've got adequate hay. We made a lot of hay early. Sometimes quality might not have been real good. We did get affected a little bit late in the year, but bottom line is my sense is that we probably have enough hay, but the price is up in Oklahoma. And that's really a reflection of what's going on around the country. You look at some other states, particularly where the drought is the worst, North and South Dakota, other hay prices, non-alfalfa hay prices are up 60 to 70%. Montana about 40%. And so, again, there's obviously tremendous forage issues there, challenges for those producers trying to figure out how to get through the winter and whether or not they are going to have to continue culling cows. At this point in time, of course, they're not going to grow any more forage. So they're figuring out how to get to next May or June before they're really going to be able to see any change in their situation. So hay prices are up. That's a challenge for beef producers in Oklahoma. Winter feed costs, you've already heard that from Rodney and from others, that the input costs are higher. We got to manage that. Some of you have seen this. I've been calculating this for about 20 years. Oklahoma's kind of a unique state. We rely almost entirely on other hay, non-alfalfa hay, for our beef herd. Okay, we grow a little bit of alfalfa and we sell it to the dairies. So we don't use much of that, unlike those northern states where they use a lot of alfalfa for beef and dairy cows. If you take Oklahoma's other hay production every year, divide it by the number of beef cows in the state as a broad measure, and I'll grant you that it doesn't account for everything, but you can see what's happened to that over time. In short, holy cow, what happened? We are going to get done quick. And that's probably good, but let me just do this one thing. From 1970 to 1984, that 15-year period, we produced an average of 9/10 of a ton of hay per cow. For the last 15 years, ending last year, we've put up an average of 2.25 tons of hay per cow. Now, I don't want to go on my usual rant. Some of you know that I like to smack on round bales and other things. It was a great labor-saving invention in the mid-1980s when that thing started going up. And there's nothing wrong with saving labor, but it also turns out to be one of the greatest hay wasting and sloppy management devices ever invented in terms of forage management. So my point is, we need to manage cost a little bit more this winter. Maybe we ought to roll out them round bales and know exactly how much we're feeding and who's eating it and whether or not they're eating most of it and not just part of it. Okay, that's enough of that rant. Other feed ingredients are high. Again, you've heard this before. Corn's up. That means all of the other feed ingredients are higher, some more than others. Cottonseed meal, 78% higher than this time last year. Cottonseed, or excuse me, that was cottonseed. Corn gluten feed, distillers grains, wheat midds, whatever you want to look at, they're all significantly higher. That's a challenge for producers in terms of supplement needs. Obviously, driven by corn, that's an issue for the feedlots. Feed cost to gain, or cost to gain in the feedlots has gone up dramatically this year. That affects how feedlots feed cattle. It doesn't mean they're not going to feed cattle. They're going to continue to feed cattle. The cattle are out there and they will get fed, but it might impact how they're going to do it. One of the things we see when feed prices get high, on top of the normal seasonal things that happen in Oklahoma, that blue line was the average auction prices across weights in early September. The red line was last week's average auction prices across weights for steers. Prices have gone down a little bit, particularly for the calves. It's that time of the year. They're going up a little bit this week because there's nothing like a rain in Oklahoma in October to make cattle prices go up. So we're going to pick a little bit of that back up, but there'll still be some seasonal pressure for another month or so. But the other thing you see is that line gets really flat. In fact, the cheapest animal walk-in last week was a 625-pound steer. Everything up to 900 pounds brought more than that last week. That happens every year to some extent in Oklahoma. It happens even more when feed cost in the feedlots goes up. Because when feed costs go up, the best defense feedlots have against that is to try to buy more weight out of the country and not have to put it all on using expensive feed in the feedlot. And so we're seeing that play out. If you're a stocker producer, you should recognize that that means a higher value of gain potential. And so, what the feedlots decide to do is going to tell the stocker guys what to do. And in this case, the feedlots are telling you, put weight on feeder cattle for us and sell them to us bigger. So that's there. You got to figure out how it works. You got to figure out your risk management around that between now and next spring, but the opportunity is there. This is a 12-month moving average of feedlot inventories. This kind of gets to some of the issues we've been dealing with this year. I use a 12-month moving average. It takes out the seasonality, so you can compare any of these numbers or these positions to another one, and the changes are not due to seasonality. They're due to whatever's going on average. And what's important here is that we have gone through all-time record feedlot inventories that peaked only in June in terms of this 12-month moving average. The monthly numbers themselves actually peaked in February. And we're slowly beginning to come down. Bottom line is we've had lots of cattle again. That was that pandemic-induced bunching of cattle from late last year into this year. That's been our problem with the fed cattle market. We've got to work through that and get these numbers down enough to where we don't have a problem. You look at fed cattle slaughter, you can see what happened last year for 2 months. We bounced right back. The red line is this year. There's not a lot of difference in that. In fact, if you look at it this way, this is monthly slaughter for steers plus heifers. And the only reason to do this chart is just to show you that this year hasn't been a lot different than previous years. And I say that because there's been a lot of talk about the fact that fed cattle market has struggled because packers aren't killing enough cattle. Packers are killing all the cattle they can. They have got labor problems that restricts how much they can kill, but those labor problems have been there for a number of years. They're not new. We've had to use more Saturday slaughter and other things to try to make up for it, and for the most part, we've done pretty good this year. So we've got a cap, and again, it's those large feedlot numbers that have to work their way down below that cap before we can really see this fed cattle market kind of turn around. Carcass weights have been going up for a long time. There's all kinds of stories you can tell there. Last year, they jumped 28 pounds for steers in 1 year. They had long-term averages like 4.5 pounds a year. So that's a bit steep. Again, pandemic stuff. Last year was the first time in history, well, actually, technically the second time, but really the first time that steer carcass weights averaged more than bull carcass weights last year. And I've talked to you before about when these cattle are going to quit getting bigger on average. And the short answer is, I don't know. I've been wrong for 25 years, so I quit predicting that. Carcass weights are finally beginning to come down. I think that's due to 2 reasons. Feedlots are getting more current, and the high cost of gain gives feedlots a pretty good incentive not to hold those cattle any longer than necessary. Okay, so we're probably doing a better job of marketing these cattle more timely. Again, we are beginning to get our supply relative to capacity issues straightened out, and we're doing a little better job there. Beef production this year for 2021 will be the 3rd or 4th year in a row of record all-time beef production. It would have happened last year, in my opinion, had we not had all the pandemic-related disruptions. But here it is. We're going to peak this year, and we do expect beef production to begin falling. Again, think about that cattle cycle. Numbers peaked in general in 2019. We've about got them all worked through the feedlots. We're going to be moving into tighter supplies of cattle and ultimately beef production as we go forward. You've heard a lot about trade today, so I don't need to spend much time on this. I'll just reiterate a couple of the points that Kent made earlier. 2021, January through August, year-to-date numbers, we're ahead of 2018, which was the previous record year for beef exports. We're ahead of that significantly. We will set a new record, barring something completely unexpected in the next few months for beef exports in 2021. And you can see where it's at. Japan's still our biggest by a little bit. South Korea is closing the gap, but the big growth really has been in this China-Hong Kong market. I think that the rate it's going, and it may not continue to grow at quite the rate it has over the last few months, but I think it will continue to grow. I think there's a good chance China-Hong Kong might be our biggest export market in total in not too many months. It won't happen this year, it might not happen next year, but on the pace we're on, certainly by 2023 or something, we could be there. On the import side, we did see a little spike up in imports last year. They're coming back down this year. That was all supply chain related stuff. Again, Australia, you note, has had major problems. They are trying to rebuild now. So they'll be back in the game in a bigger way. Canada's a little bit bigger share of things than relative to the others in recent years. Okay. Annual average cattle price. Again, if you want numbers, they're in those tables. There's the picture from where we are now, 2021, our general expectation for 22, 23, higher prices, okay? In the neighborhood of 10% plus or minus. Okay, again, you can look at those tables for specific forecasts. Now remember, those tables are good only until I can reprint them. Okay, which will be sometime in the next month. We will update them constantly as we go forward, but that's the way it looks today. Okay, and so that's the picture now. We can end today on a good note in that we generally have expectations for higher prices. Obviously, if we could go 12 months without a black swan in this industry, that would be a tremendous feat in and of itself. And it would help support this idea if we can get by without any other major unexpected shocks like we've been subject to continuously and repeatedly for the last 2 years. So in summary, cattle prices will be higher. So will input cost, in particular feed cost. Going to have to manage cost. Profitability prospects are better. Certainly the revenue prospects are better if you can manage cost. There are some better opportunities potentially for profitability. That's how you find me. It's not hard. And we did it in about 10 minutes or something like that. Any questions? All righty. Thank you very much.